Well, hello. Hi there, guys. This is Vinney Chopra. Many of you have seen me in social media, in YouTube, and just Google my name. And actually, this is the podcast I do, which is the sequel to my book, 325 reviews now, 4.5 to 5 stars, mostly 5 star reviews all across the world, from Italy to India to New York, USA. Of course, I was going to say England, Australia, all that. So please, if you have not looked at it, go ahead and pick a copy. You will really, really learn a lot about investing in, commercial investing and also apartment syndication. And then my other book is The Positivity Brings Profitability. Some of you might have seen it, and that's also out there on the Amazon. Our third book is coming out, which is going to be in about a month or so, on senior living investing. So thank you for really following me, giving 5 star reviews, and also sharing this podcast if you really, really like it. I've got 5 podcasts now a week. Just to let you know, my senior investing show through StreamYards that goes into 7 channels, that we do it on Thursday mornings at 9. Then my Vinney and Bo show on the lending side and the moving your business to the next level. That's on Friday, 9:30. Then my other 2 shows are this one and my motivation. And then the fifth one is going to be on Millionaires Playbook, which is going to be Monday morning motivation show. Hi there, brother. How are you? So sorry I have to do this selling in between.
No problem at all, Vinney. Glad to be here with you.
Thank you, Dan. Dan, today I'm very, very excited, to know Dan for a few years now. He and I met actually one-on-one right there in Atlanta, Georgia, if I remember. 2, 3.
That was our very first encounter together. That's where we first met, and we were sharing the stage together. Didn't even know it.
We were. And, I'm so pleased, Dan, to see your success, your team's success, and congratulations to you, buddy.
Thank
and
you.
For the leadership and what you're giving to your audiences. And I'm really, really very, I want to wish the very best for you and your success. So let me kind of give a little bit idea who Dan is. A lot of people, everybody knows, I'm sure. So Dan Hanford is a managing partner with passiveinvesting.com. Remember that name, passiveinvesting.com, and has acquired 2,680 units with plus actually more, every week, every month, with a portfolio valued over 357 million and counting. I'm sure it's going to get to $500 million, then billion, 2 billion, like that. He is also a passive investor in 5,700 plus units. That's amazing, to put your own money into the other deals. Himself, Dan, prior to getting started in real estate, has extensive background, medical too, right? Yeah, medical background, in starting multiple 7-figure businesses from scratch. That's amazing. He's just a bundle of, ideas and creativity. And I just feel like social also media and the meetups, and how he's really taken this whole multifamily investing bull by the horn. I want to dig into that today, from scratch. Dan also runs a very popular group called the Multifamily Investor Nation, which is very, very popular, Dan. And you also do 2 summits, which I've spoken at in January and June. And I know lots of great content, a lot of great speakers come there and share their knowledge. So I hope everybody following me, please look for that, in the month of November and December, will be kind of coming out to you to get your seat going, get your ticket right away. And then quite impressive background, let's welcome Dan, to the show. Thank you for taking the time, Dan. It's a pleasure, brother.
Glad to be here with you again, Vinney. Looking forward to diving into some the material today and sharing with your audience and providing some value.
Oh, thank you. Thank you so much. Again, give us a little bit background. Of course, your wife, Danae, and then children. How many children you have?
We have 4 now.
Four children. Congratulations. And I know I see on Facebook your pictures and with the family time. That's so important. I hope everybody watching us, you got to make sure it's not work, 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 work. That's not which is going to get us. Legacies are left when we are giving proper attention to our family, our children, our whole life has to be a balanced life. Because money, we came with zero money. We're gonna go out of this world with zero money. It's gonna be all left behind. It's the legacies that we leave. So yeah, no, tell us. You are in South Carolina, Columbia,
Yep.
and maybe if you want to tell some of the new audiences, we're getting a lot of downloads now. 40,000, I just heard from my team. So uh, yeah, a little bit background, and then we can dig into Dan, like what you think about COVID, and how do you think about 2021? I mean, and a lot of other avenues that a lot of investors want to know, right?
Sure. Well, I'll tell you a little bit about my background first, kind of fill in some of those gaps. So I actually have, like you mentioned earlier, a group of 4 non-surgical orthopedic medical clinics that I started back in the early 2010, 2011 era. And since then, they have gotten to the point where they're cash flowing very nicely. And of course, that cash flow causes another problem, which is called taxes, right?
Yeah.
And so that's really why I started into the real estate side of things, is to help reduce my taxable burden that I was having at the time. And I didn't want to start off small inside the single family space. Mostly in the beginning was because I didn't want to start somewhere small when I already knew I had built something to the point where it was really big, and I didn't want to start from the scratch again and go and do something small. And so I actually hired a mentor and had him help me be able to reduce my learning curve, and started the group passiveinvesting.com and teamed up with my 2 partners that I have now. We've all 3 been together since the very beginning, and it's been great. So we started off by our very first property that we bought by ourselves was an $8.9 million property. Fast forward to today, that in 2 weeks we'll be closing on our largest acquisition, which is a $57.6 million project, raising about $21.49 million for that deal. And that's actually our second really large deal that we've done, or our third large deal. We actually closed a $51.5 million deal at the end of last year, and a $49.95 million deal earlier this year. And then we'll be closing 2 more later this year, actually a $27 million deal and about a $21 million deal as well.
Congratulations. Wow. That's amazing, Dan. I remember the days 14 years back, I bought my 14 units, for 180,000. And then, the progress has come. A lot of people know what we have done and so forth. So, but you're so right. I think if we stick in there and you are able to raise good amount of money, give the good investors great conservative returns, right? Our projections and everything, and syndicate rightly, and then take care of the investors. This can become a huge business like you have done. A lot of other people, Joe Fearless, Grant Cardone, myself, a lot of other, investors.
And I think the one reason that allows you to have the success that you have, and that is one of the reasons that we've had the success that we've had, is that a lot of groups stop once they close a deal and say, that's it. I don't need to continue the relationship with those investors. And in my book, that's actually really when you need to ramp it back up, actually, because you have to maintain that level of a certain level of communication with investors, so that they know exactly what's happening on the property, and so that you can continue to build that relationship with them, so they don't feel like just a number. And our group, just like yours, is not trying to put together just, one project and that's it. We want to continue to build a legacy wealth for ourselves, but also for our investors. And we just grow together, and we do not just one deal, but multiple deals over many, many decades.
So true. So very true what you're just saying. Dan, also, I think I might have mentioned in my other podcast, I do like 4 meetings after we just bought the deal in Austin, 34,750, just 3 weeks back. So next month in November, I'm going to hold a meeting. Invite the investors in live on Zoom meeting. We're going to record it, and I'm going to take them through the closing statement. I'm going to take them through the legal structure. I'm going to take them through the PMA, the property management contract that we have with our, outside property management company. Now we are getting in Austin, things like that, so that my investors can sleep good at nighttime. Then the next month, I'm going to share them the software, the real page and everything, and how all this is authenticated, and how we keep only one set of books and all that. Then I show the third month, again, what we have done in the first 2 months, our business plan. So I bring the pictures of the property and the staff to them, the marketing to them. This way they can really feel good about, what they have invested with the right syndicators. And and you do the same. I know even more, right?
Yeah, it's the communication level is one of the missing pieces to a lot of groups where we get a lot of donor investors, and I'm sure you do as well, from other groups that they come and they'll basically get on an investor call with you and be like, I don't want to invest with this XYZ group over here anymore because they don't ever communicate with me. I don't ever know what's going on. And I know we're going to kind of touch on the topic of COVID-19 here in a little bit, but one of the things that we did earlier this year is once we knew that there were some unrest when it came to the COVID-19 and unknowns as to collections and things like that on our properties, we typically do a monthly email update to our investors so that they're aware as to how the property performed in the prior month. And what we did during COVID is we just made the executive decision that we're going to send out an email every single week to our investors so they know exactly how the property is performing during this time of uncertainty. And it allows, just like you said, for those investors to sleep well at night because they don't have to be, reactive and trying to get information from us. We try to be proactive about that so they are aware of exactly what's going on. And of course, most investors realize and understand that these are investments. Investments do fluctuate, but I also want to be communicating with them about the good things, but also the bad things when they come along as well.
So true, Dan. I mean, that line of communication, that urgency to get them so that they don't hear from somebody else, but you are able to share with them the news. And most everybody really are watching TV and newspaper. I mean, everything negative is coming out. I know they are not really sleeping that well unless we get in touch with them. So true, so true. And the other part is it's the overarching vision. Remember, one investor is not one investor. I learned that 43 years back through a book. They say there are 44 people behind that. Interesting. So they said, you never treat a customer as one customer. You always treat, there are 44 people behind. They may not be behind, but they will be in their tree, in the leaves and branches, in their circle of influence, their family, their friends, and they will tell, and they will tell, and they will tell. So the more time you spend with the investor right up front and shield them, that's the word, shielding them also, then they will just make a fusion. Like in physics, we have the term fusion. You can drop these great investors all around in the country, then they're actually your promoters. They're just telling your stories to other people. So
we have a printed newsletter that we mail out to our investors every month, and it's a very well done, kind of professional, full gloss, kind of almost like a magazine style that we send out. It's usually about 12 to 16 pages, and each one of our partners writes an article inside of that newsletter. We also do an investor profile and things like that. And one of the things that we did, if you kind of think back to the put your marketing hat on a little bit for what you were saying, we inside that newsletter this past month sent a second newsletter and then shrink wrapped it and put a sticker on the outside that said, this second newsletter has been printed up for you to send or pass off to a family, friend, or colleague.
I love it.
Material to be able to give off to somebody else.
Pow, bad, dynamite. I know we do in our property management because we are vertically integrated, like resident referral. And I've been doing referrals for 44 years because I was in sales, motivation, this and that. But asking your good, happy, investors to give you testimonials, video testimonials or written testimonials. Some are private. I see that in my investors also, but they don't mind if somebody wants to look at me. I just ask them, text them, see if you can talk to them for a couple of minutes or whatever. That's even better because then people are able to talk with a live person who has been working and investing with you millions of dollars, things like that. But you're right. It's so important that we always be thinking how we can take care of our present investors and how they can send the best story to other people. So true. And then let's talk about COVID then, how the properties are doing. Like you said, you're weekly now communication. That's amazing. Did you also stop some of the cash flows just so that we can have reserves and things like that? Or how did you do?
Well, one of the things that we do on all of our acquisitions is from the very beginning, when we close on the property, we make sure we have plenty of operating reserves.
Beautiful.
And even that one deal that, just to give you a quick example that we're closing, which is the $57.6 million deal, that one actually has a little over 1.7 million in just extra operating reserves the day we close on the property.
Yeah.
And some people might look at that and go, oh, it's a little bit too much, right? Yeah. But we also want to make sure that we can mitigate any type of risk of a capital call to our investors in the future. And we don't think we're going to spend the full 1.7, but it's there, especially with the unknowns of what's going to happen into the future with COVID. Could be another short-term blip on the radar, if you will. But we always want to make sure we have plenty of operating reserves. And so we had that on all of our assets. And so we, as far as the cash flows were concerned, most of our assets are in that B+ to A+, or that A kind of range. And so we really didn't see a major impact. We had like a drop of collections by like maybe 1 or 2%. And so we were able to maintain our investor distributions even throughout the pandemic.
Awesome. I know my C-class properties in Texas, which I'm selling, they did get hurt some, but otherwise the one in Melbourne and, in the Florida, we were collecting 98% of the rents in the tech sector and all. And
that's basically what we were seeing too. The lower end assets were the ones that were getting hurt the worst, because that was the sector that really, when they lose their job, they don't have a lot of excess to be able to live, and they're usually paycheck to paycheck. And it was a part of the industry, or the segment of the economy, which was the restaurants and the entertainment and the leisure, that were really having a lot of really a major impact, because your other kind of middle of the road, a blue collar or high collar or white collar and resident actually was able to pay their rent, right? Because they were usually either just working from home, or they had some backup, in savings to be able to pay their rent.
So true. So very true. I was going to say what you just mentioned is so right. I hope the syndicators kind of, look at us, because the thing is, you've got to have operating budgets, have that capital. It's much easier to raise from the investors. Like in our deal, we did 65% LTV because of the unevenness and everything. We got 2.59%, I think, loan from the Freddie. And like the Austin deal we just bought, right? 983 was the COVID reserve. 983. And then we raised 1.7. You said 1.7. That's exactly what we also raised on top of that, to keep that money for CapEx and for operations and things like that. So it's much better, what you're saying. I've never done a cash call in my life for 14 years. Sometimes I just loan $500,000 or whatever to the LLC at zero interest, even though my syndication attorney says, Vinney, you could actually charge 8 or 9% or like that. We have never charged, but it's good to have that, the money, which you are not getting into a bind, So true. So
great.
Just tell me, you have been really doing so well in raising so much money. So give us some nuggets to the, listeners, how you have been able to develop that machine.
Yeah, the biggest thing I would say is that a lot of people will ask us, what is the number one thing you do to be able to bring in investors? And I always look at that and go, it's actually the wrong question. It's really, the question really should be, what systems do you have in place that are allowing you to be able to be consistent with the inflow of investors? And I'll pull it up here. We actually use Active Campaign, which I know a lot of people do.
Oh yeah. Please
go ahead. Go ahead.
Yeah. I'll give you permission if you will share.
Well, I won't be able to share the screen with you because it has other information on here, but
okay. Yeah.
Look it up, and basically, when you log into the dashboard, it'll tell you how many leads have come into your platform in the last 30 days. It's a rolling 30-day number, and we've had 174 right now in the last 30 days.
Wow.
And that number has been consistently increasing. And when we first got started, it was 3 or 4 or 5, and then continue to put in systems and procedures and processes in place, and it just continues to increase 20, 30, 40, 100, and now we're at 174. And the reason why it's like that is because we have systems in place. And some of those things that we do is, one of the things is, you mentioned the Multifamily Investor Nation, and we now have a little over 31,000 members that are part of that group. And it has allowed us to be able to have a presence, a very large presence in the multifamily space. We actually have the #1 podcast for multifamily on iTunes. So you type in the word multifamily, would come up #1. And we didn't try, it wasn't because we got a bunch of reviews or anything like that. It's because we're providing really valuable content and people are downloading it consistently. And when you have a podcast that's downloaded consistently like that, iTunes recognizes that and they'll push you up even higher. And so, it's the podcast is one thing, the Multifamily Investor Nation with the weekly webinars that we do and the MFIN Summit. And then we also have our YouTube channel and our LinkedIn presence and our Facebook page and our Facebook group. And we have the full meetup groups. We now have a little over 50 meetup groups across the US, Canada, and the UK. And so as we continue to expand, we're continuing to increase our reach with people. And one of the biggest things that we do that I think has been the biggest success for us is we provide value to other people. So we have a very large value driver for being able to teach people how to do syndication. And you probably realize this as well yourself, Vinney, that there's a lot of people that think that they want to do syndication, but then when they get into it, they realize, holy moly, there's a lot of moving parts here. I don't want to do it. You
For sure.
You do it, right? And so we get a lot of that. And then we also, we actually have quite a few of the well-known syndicators that invest with our group. And it's because they have a self-directed IRA or a 401k and they can't invest in their own group with that. So they invest with us through those types of retirement accounts. And of course, when we get those types of investors, it just helps to kind of build our own credibility as well. And I don't go out there and like mention their names or anything like that, but because obviously for anonymity's sake, I don't want to do that. But it's always nice for us when we get that, soft commit that comes in and it's somebody that we know in the space and we're like, oh, that's pretty cool. That person, is investing with us. But there's a lot of things like that. And then of course, being on podcasts like this and trying to be, speaking at events when we're able to speak at events, right? Live or virtual, especially when we're seeing right now, a lot more virtual ones. And so it's never been just one thing that has allowed us to be able to get where we are today. It's been I always call it like a multimodal approach to marketing or advertising to be able to, fill the funnel with new investors so we can start to build relationships with those investors. And then once you put them into that funnel, you have to make sure that you do have a system on the back end to be able to build that relationship and deepen it even further. And that's where our monthly newsletter that we mail out every month comes into play. And yes, it is a lot of work to put those together, but it also, I feel, produces a lot of result from it. And we get a lot of feedback from our investors about kind of how we think, how articles in there that we think that our investors will want to understand about, what is an IRR and what kind of impact does it have? Why should you be looking at it? And, what is it the end all be all as far as, evaluating a deal? And, I wrote an article last month on unreturned capital contributions and what they are, because a lot of people hear that when they look at these PPMs, but they don't really know what that specific term is and how it impacts your returns. And then of course, preferred returns versus preferred equity and capital stacks and structures and equity waterfalls and a lot of these complex terms that a lot of investors are uncomfortable with and not familiar with. Try to write articles about those different topics so they understand them more. And then of course, as we're doing renovations on our property and things come up, we'll write articles about that. And so there's a lot of different pieces and that are moving at all different points in time that are producing referrals, like we mentioned earlier, but also that are producing just new investors that are coming through our fold as well.
So true. So very true. Yeah. That's exactly, that's the key. I think nowadays with the social media so prominent, people, investors, they want to see you. They want to see where you have been and what's your success. And they look at, Google you right away, right? All that. Actually, it just happened, by the way. One of my investors in my senior investing 500,000 from the next town over, Walnut Creek, they had a private investigator to find Vinney Chopra. So then they wanted to meet with me. Literally, they said, Vinney, we need to meet with you. We found 13 indictments and this and that and all. When I met with them, I said, you know what? That's a wrong Chopra. Sorry about that. Then I gave them my social security number. I gave them my address, 3 addresses. We have lived 40 years in the Bay Area, everything. 3 days later, they said, oh yeah, we are signing the PPM. And here is your $500,000, So you're right. People do really want to know that they are putting money with the right syndicators, with the right groups. because it's not just making money, it's the preservation of capital and really making sure who the partners are, at the top, and how will they run the deal for the next 5, 6, 7 years. I mean, it's not in the buying the deal, it's how it's going to be run to bring about the numbers and the equity returns and everything. So
Yeah.
it's very important. And you're educating them. That's so great. It's amazing, that all the things you shared. I hope everybody kind of listens back and watches again, because all those are important aspects of getting your brand, out there, so that, and you will start small. I mean, everybody starts small, but then you are able to get the right partners, like you said, Dan, your two other partners, and I met them actually in January. They're in Florida, right?
Yep.
Yeah, we were there in Orlando, Florida, and we met. And so, no, very, very good. Very good. How about 2021? Let's talk about that. I hear a lot of properties are going to be out there for grabs. What you're thinking?
Well, I think that there are going to be some properties that are going to be kind of up there for grabs, if you will, but I think it's going to be primarily in the smaller mom and pop space more than anything else. In the institutional space, which is where we're primarily acquiring assets, because our minimum that we look at right now is 20 million, and then on the top end is about 75 million. And so in that kind of 20 to 75 million space, I don't think they're going to see a lot of movement one way or the other. I think it's going to probably stay pretty stable. And that's one of the things that we're seeing right now on the kind of the other side of this, the start of the pandemic, if you will, where, you started to see a little bit of, expansion in the cap rates. We're not really seeing any kind of movement at all. We're not seeing a lot of compression or expansion right now. Most of it is pretty stable. And I think it's primarily because interest rates right now have been at an all-time low, even for these multifamily assets, like you mentioned earlier. And so the cap rates have been staying pretty stable. And so we're not going to probably, I don't think we're going to see a major, change in 2021. I think it's going to probably stay at least through the year of 2021, and maybe even into 2022, depending on what the Federal Reserve does with the interest rates and things like that. But I think that in the smaller space, you're definitely going to be able to see some deals trade with basically people who are maybe working a job and they're trying to manage a property at the same time, and they just get frustrated with it and they're going to throw their arms up and just try to get rid of it. Those are going to be the ones you're going to see the most. But when you have an institutionally ran property, these institutional sellers and buyers, they're not, especially the ones that are holding on, those owners, institutional owners, they know how to manage their property in the middle of a pandemic or in the middle of a recession. And so, they can hold on to it because they usually have plenty in capital reserves to withstand through this. So they're not going to sell in a downturn, or they're not going to sell in type of a recession. They will hold on to it until the other end. And that's what we're going to do as well. So if for some reason things change, I'm telling our investors now, we got 3 deals right now. We're getting ready to close between now and the end of the year, and one of them that we're selling actually. And what might happen is there could be another run up of the pandemic, right? Could there be another session of closings and shutdowns? It's possible. A lot of it's hinged upon the election, but depending on what happens into the future, there might be some short-term things that come about. But again, we're acquiring these properties right now for a 5 to 7 year hold period of time, depending on the asset. So I'm not really too concerned with what's going to happen in the short term, because these are long-term plays, right? And so if we can continue to preserve capital, like you said, but also be able to have a nice, decent return for our investors, even down in a recession, that's what our goal is.
Surely. No, I totally agree. Dan, I mean, the big thing is that, even talking to Executive Vice President of Northmark Capital, she was explaining that, there has been maybe 3% is the number she said, up or down, right? That's all. Nobody's looking for that 10, 15%. Some people thought that they might get it through the COVID. And of course, with all the things that you just mentioned, it's going to be in the mom and pop, smaller number of units. We'll see some more upside and lower pressures, if we say for the value.
At the height of the pandemic, I was actually, people were asking me, where do I think that the properties are going to trade into the future? And I projected 4 to 7%. So it was actually a little bit less than that, right around that 3% range. So obviously, I think again, it's going to be in those smaller, mom and pop properties. I would say most properties, not most properties, but the properties that you're going to see it in the most are the ones that are in that probably, maybe 10 million or less, or maybe even the 5 million or less properties that you're going to be able to see that the most.
So true, so true. No, thank you. You've given so many great nuggets. What could you say, maybe some more comments about some passive investors, let's say? That's your passiveinvesting.com. If you want to share that, love that. And also to the new investors, right? Who want to kind of do syndications like you and I, maybe a couple of things for them then before we wrap up.
Sure. Well, I mean, for the passive investor, that's how I got started myself, is actually passive investing first. And, even today I'm still passive investing. I actually committed to 2 deals even earlier this morning that are going to be closing here between now and the end of the year. And so I would suggest, when it comes to the passive investing, getting to know your operators, because that's how you're going to really understand how they operate. And you also should understand how the deals are put together and how they're underwritten. So for me, what I would suggest is learning the underwriting component the most, right? Because you really don't need to have to know, you as a passive investor, it doesn't really matter how they found the deal. It doesn't really matter, a lot about a lot of those different things. A lot of it has to do with how is the deal underwritten? And if you understand those metrics, you'll feel more comfortable, especially when a lot of times right now we're seeing a lot of dual tiered structures, which our group does as well. But if you understand the dynamics of a preferred equity position or a common equity position, and understand where you sit in the capital stack and the structure, will help you be able to make better decisions as to where you place your capital. And because you'll be able to know which ones are higher risk, which ones are lower risk. And there's a lot of different things about that. And that's one of the things that we try to write about to our investors, so they understand exactly why we do what we do. And so that then we can try to have that open dialogue and communication with our investors. But first thing I would say is become educated about the space, learn how to do underwriting. And when you learn how to do underwriting, it'll help you understand the numbers better. So you're not going to learn underwriting to the point of being able to underwrite it yourself, right? You don't need to know that level of detail, but you need to know how to do enough underwriting so you can actually look at the pro formas, and you can look at some of the return metrics. You can look about some of the debt and the financing that's on there, and does it actually make sense, right? And is this really truly a conservative investment, or are the numbers being just puffed up? Because Vinney, as well as I know, that I can make the spreadsheet look really, really good. It's very easy to do that, but I would rather project that you're going to get a little bit lower return and then outperform that. Because if I tell you I'm going to get you a 17% return and you end up only getting 15%, even though 15% is really good, you're going to look at me and go, you failed. You didn't make the 17%, right? So I would rather just project 15%. And if I get you 15%, great, I'm still a hero. And if I get you 17%, I'm a superhero, right? And so that's one piece of it, is being able to really understand the numbers and know what you're investing in. But definitely have phone calls with these operators and ask them some hard questions about how they operate. Ask them questions about maybe talking to some of their prior investors and seeing some of their experiences, and making sure that you ask other people. I mean, this is a very small space. So if you reach out to anybody in the space and you ask them, say, hey, what do you think about this person? What do you think about that person? They likely have an opinion about them, and they might have even have invested with them. So I haven't invested with every group in the space, mostly because there's many of them that I wouldn't invest with. But I do have investments with 9 different operators in the space through my 32 different passive investments at this point. So definitely get out there and talk to people before you invest with them. And then as far as the active side of investing, for those of you who are interested in really becoming active, my biggest suggestion to that is to passively invest first. Your first step into this kind of industry is being able to first invest your own money into a project first. And then once you've done 1, 2, 3 deals, then move into hiring a mentor and having them help you reduce your learning curve to be able to, scale faster. Right. And if you want to start smaller in the smaller, multifamily space, that's fine. There's nothing wrong with that. If you want to start in the larger space, you can do that as well. I personally started right out of the gate into the large multifamily space, and we haven't looked back. Right. But you don't have to do that. Everybody's a little bit different. And actually there's mentors that will help you based on what you really want to do. So if you want to start small, there's ones that usually did start small themselves and they work their way up. And then there's also ones that did just the large multifamily from the very beginning. And so you have to find a mentor that will fit with what your goals are for what you're trying to do. And then the next thing that I would suggest you do as a active investor is to first, before you start taking down your own deals, co-GP or co-partner with another operator first that has some credibility. That way you could build your credibility with your family and friends and other net investors by partnering with a group that already has credibility. But it'll also, from the broker relationships and these seller relationships, it'll build your credibility as well. And you can start by co-GPing with somebody else. And I don't mean just like raising money for them, right? That's not what I'm talking about. I'm talking about truly co-partnering with them where you are active in every facet of that operation so you can fully absorb and understand what is going on. And then at the same time, it can also build your credibility. Then once you've done a couple of deals there, then you can start to look out for your own deals where you've already now built your credibility, built your reputation, because you have to be able to maintain that level of reputation with your brokerage relationships as well as with your sellers, because they all talk, right? They all talk, and they know whether this particular buyer is going to be a good, solid buyer or not. And so you have to make sure that you don't tarnish that relationship. And then once you get to that point, it's really kind of that first deal, right? You know, once you get that first deal under your belt, the second, third, and fourth ones come pretty easily from there. But one of the things I also see in this space, and you probably do as well, Vinney, is I see a lot of groups that start up and they kind of build up, and then they buy one or two deals, and then they just kind of like peter out, right? And you never see them again. You never hear from them again. They don't do any more deals. And it's been years and years since they've had a deal. And a lot of times people get bored with it. Yeah. And so you want to make sure that when you're, you know, going back to the passive side, when you're investing with somebody, you make sure that they have plans to continue this into the future. They're not just trying to build a portfolio enough so they can quit their job and just live off the cash flows, right? You want somebody that wants to continue to have that drive behind them, and that can continue to build and scale after that as well. And same thing with you that are wanting to be active. Build within apartment syndication. Don't think of it as just I'm building a real estate investing business. You're not. You're really building an apartment syndication business. Or what I would encourage you to change it from is you're building a private equity real estate firm is what you're doing. And so you have to think about it as a business, and don't treat it as just like a side hobby, a nights and weekends kind of hustle. This is a full-time business that, yes, it does have a lot of benefits with, you know, having flexibility with your time, but you also have to make sure that you are building out a team to be able to manage your investments, but also manage your investors at the same time.
For sure. No, Dan, you said it so right. All these great nuggets, you know, I mean, definitely right on the target. And, you know, I want to really promote your summit. You know, I mean, it's coming up in January. Do you have the dates yet? Yeah,
we do. Yeah, it's January 21st, 22nd, and 23rd. Let me just double check and make sure that's correct, because I might have them off. Yes, January 21st through the 23rd. And if your listeners want to find out more information about that, they can go to mfinsummit.com, and you will have a promo code on there as well. So it'll probably either be Vinney or Chopra or something. So I think it's usually Vinney. So you can type in Vinney, and you can even get a little bit of discount on there too.
Sure. No, I always enjoy, you know, coming on that and presenting. And actually this year I'll be presenting on senior living, which is the safest multifamily, you know, segment, which I've really dug into now. I'm buying multifamily hotels also. I just bought one in Texas. I'm buying 7 portfolio, another with my partners. And then we got a branding company now. And then also with the senior living investing, we'll be doing the build up for 3 years kind of thing. And then we are becoming the REIT also, where we'll be buying after 3 years ourselves and giving investors spectacular returns and so on. So there are 6 different companies that, you know, we are just kind of exploring. But no, thank you so much for your time, Dan. It's been such a pleasure, brother. And we're going to put the links below. Please do reach out to Dan. If, if I can be of any help, reach out to me, Vinney Chopra. That's VINNEY CHOPRA Chopra.com, VinneyChopra.com. And don't forget to like, subscribe, comment, and even share this episode if you think some other people can really benefit from it. And give us some good 5-star reviews if you would. Like Dan said, you know, the iTunes, they look at all these reviews and then scale up. And congratulations on being #1 show. I'm so proud of you, Dan. That's awesome.
It took a long time to get there, but we did it.
No, that's great. And you know, the value you're providing, please reach out to Dan's website and, you know, look at newsletters and other things, because I know all those things really make us strong investors. all those things make a strong believer in the system that he and I and others are promoting. And there's so many, $28 trillion with a T is the money, retirement accounts, but only so small, 3 to 5% is into syndications, into real estate, like Dan and I do. So there is a big road ahead, but please get yourself the knowledge so that you can make the right decisions. Again, we are not selling any securities or anything. We are not attorneys. We are not CPA. All this information is for entertainment purposes only. And remember, please go ahead and look at Dan's, on his website, and look at for my books. My third book is coming out. I don't know where it is, right over there, which is going to be the senior living investing book. And then my fourth book is coming, Apartment Lending Made Easy. So I'm just kind of churning out these books with my partners to educate lots and lots of people. So this is the one which is going to be published very soon. It's almost ready. That's the Senior Living Investing Made Easy. The Made Easy is my brand now, right? Like I did my first book, and then Lending Made Easy. Then we are putting another book together so that legacies are left behind. Thank you again, Dan. Buddy, any parting thoughts? Anything you want to share with last thought with people? Yeah.
No, nothing really specific as far as like a kind of a final thought, but definitely if you're interested in following me more, there's two different ways. One is passiveinvesting.com to join us on some of our future opportunities. And then if you're interested in the active side of things, you can go to multifamilyinvestornation.com and you can sign up for our weekly email list where we do our free weekly webinars as well. Awesome. I really appreciate you having me on, Vinney.
Thank you, Dan, for your time, for coming on the show, brother. And thank you. And again, kudos and all the congratulations and all the best wishes for your success, your partner's success. And, I look forward to seeing you, reaching the highest mountains with 2 billion, 3 billion, in real estate. And, so good luck to you, huh? You bet.
Thank you.
Thank you so much. I'll see you at the summit, buddy. Yeah.
Yes, you too. I'll be there.